Hey guys, how you doing? Welcome to the channel. I'm Kent Tilley. This is Chad Weeb. Today we're going to talk about 6 very common financial misconceptions and just our takes on them, and give some people some ideas about some noise that you hear out there from other people, or maybe you're doing some things wrong because they are misconceptions, and hopefully we can clear up a little bit of that stuff for some people. So I think we're going to leave it to Chad to
Yeah.
talk about them and ask me about a few of them. And I haven't prepared much for this, so hopefully I understand what the misconceptions are.
Yeah. No, fair enough. Yeah, I made a list of a couple here. And yeah, so why don't we just start with the first one here, Kent? I hear a lot of people say, I don't want to take overtime, or I don't want to get that pay raise because it's just going to mean that my take home pay is lower in the end and I'm going to make less money because of the new tax bracket.
Right. And this is 100% my favorite financial misconception
Yeah.
is people say, no, I got a raise and now I make less. My checks are smaller. And you're like, no, that's absolutely 100% not possible to make more money and take home less. Uh, and my favorite one was when I was a kid. I remember this like so clearly, as like, oh, that dentist only works 6 months out of the year, because if he works that extra 7th month, he'll be bumped up into that next tax bracket and he'll make less. So he just goes on vacation for the other 6 months because he makes more money that way. And I'm like, well, no, he doesn't make more money that way. He just makes so much money in 6 months that he can vacation for the other 6 months.
It doesn't sound too bad.
No, it doesn't. So I don't even know how to explain this without going through the tax brackets as each step. But all you need to know when thinking about this is that no matter how much money you make, Connor McDavid and you pay the same amount of tax on each dollar that you make. But he starts to pay a way higher like tax rate on any dollar he makes over approximately $315,000. That's when he starts paying 48% on every dollar he made over $315,000. And each bracket, you're just paying the percentage on that chunk of money. So we can all earn in Alberta about, $11 to $13,000 before paying any tax, up to 18,000 between 11. We pay 10% federally, and those keep bumping up. And so it's all about your average tax rate, and not your you're you're never going to pay more money if you make more, or
Yeah.
you are going to pay more, but you're not going to take home less.
Yeah, it's not going to retroactively affect the income
Right.
you've already earned. Yeah, you are paying more, but only on those new dollars.
Yeah, and one thing that I guess can lead to this misconception, I talk about it generally around bonus time of the year, is that you get a Christmas bonus and you're like, oh my goodness, like that was taxed way harder than my normal checks.
Mm-hmm.
Because let's say you make 100 grand a year and your average tax rate is 25%. So they're going to be peeling off 25% because they know what your average rate is going to be. And then you get a $10,000 bonus, and you would expect you're going to pull off 25%, but that's not enough, because now you're in the 36% tax bracket in Alberta. So they have to take off 36% of that, money that you made between 100 and 110,000. So hopefully that helps a little bit. It's one of my favorites. I think everybody needs to really understand tax brackets before anything else in this business and in personal finance.
Yeah, it should. Yeah, I definitely think it should be part of like high school or university curriculum or something like that. Okay, next one. This one I run into a lot, and it relates to the TFSA, or the tax-free savings account. And I know Kent did a video on how horrible of a name that is before, but it is such a bad name for what it is. The TFSA really should be the TFIA, or tax-free investment account, because it is an investment vehicle. And one of my favorite car companies, I actually used to work for them a long time ago, was BMW, and they have a saying that it's the ultimate driving machine. And the TFSA to me is the ultimate investing machine. You put your money in, it grows tax free, your withdrawals are tax free, it adds a ton of flexibility in your retirement. For those that have TFSAs in retirement, if you're on the cusp of a tax bracket, like Kent was just talking about, you can take withdrawals from your TFSA and not affect that. They're fantastic. But so many people are using them like the ultimate parked machine. I'd very, very much like to know what the percentage is of how many people have their TFSA in an actual savings account, getting 0.8% while the bank is turning around and making 6-7% on it. If you're doing that, you're missing the whole point of what the TFSA is. And just that's a misconception we run into all the time.
Yeah, I mean, there's no downside to the TFSA, and that's the best part about it is that there's nothing that doesn't make sense about investing in it. Uh, and and yeah, they are definitely the best investing machines we have. They have limits, of course, because you can only put X amount in there.
Yeah.
But most people, I remember a politician came to my door and was like, "Do you know that if they get in power, they're going to reduce the TFSA limit back down to 5,500 because in 2015 it was 10,000 for 1 year, the new limit, which was great for people with money. But the funny thing about it is that I knew this guy's advisor, and I was like, does he have his TFSA full? And no, he didn't. And so I was like, well, you're just like most people don't. Um, Obviously, it would be awesome for a lot of people to have that extra limit, but I thought it was kind of funny to be like, well, you're just like, you don't even know, right? Like you're just like saying something that helps the odd person, but it's whatever. Get your TFSA bumped up, stop putting cash in it.
Yeah, agreed. All right, number 3 here. This is for you, Kent. So I hear people say, well, I don't want to invest in non-registered accounts because the capital gains rate is 50%. And so half my investment's going to go to the government. Why would I do that?
Yeah, I mean, that's a really fair point, right? They don't understand taxes once again. And capital gains are great. Uh, Generally speaking, the 50% is because the government, and I mean, I know people hate when I say this, but if you actually like look at tax laws and tax codes, what they do is they are trying to promote people investing in things that are risky, that are small businesses, whatever, putting money back into the economy. And that's why capital gains are not taxed as high as regular income. So the 50% means that, let's say you had $100,000 invested and you made $10,000 in rental income. Well, that is income on top that you're going to pay full tax on. But if you invested in something like a small business and then you sold and you made $10,000, the 50% means that you only owe tax on 50% of the 10,000. So they have cut your tax bill in half because they know that you're taking a risk and they want you to be putting money into the economy. So that's my best explanation for that. Hope it makes a little bit of sense.
Yeah.
You love capital gains.
Yeah. And just to be clear, you're paying at your marginal rate on that half. So
Right.
even if your marginal tax rate is 50%, which is approximately the highest here in Manitoba, you're paying 25% total on your gain, because
Right.
it's half the gain is tax free, and then half on the other half.
And I had done a video not that long ago about if you're considering selling like a big capital gain, like a rental property or a huge stock gain or something like that, a good time to do it would be your first year of retirement, because you don't have any income. So then you could say sell, your rental property that in Toronto has gone from 300 to 800 million or whatever the hell it is. But, let's say you have a $500,000 capital gain, that's 250,000 in income. And so if you're making good money, that's 250 on top of your good money. But in that first year of retirement, you could have no income, delay CPP and OAS, sell that property, have some cash in the bank, and you'll significantly reduce that tax bill. So just a thought.
Yeah. All right. The next one has to do with credit cards and debt. And I mean, I do hear this from time to time, especially with younger clients when they're just starting out. But the idea of paying the minimum balance on your credit card is such a bad idea. So the minimum balance is either going to be like a flat $10 rate, or usually it's around 3%. And so Kent and I did a quick calculation. If you owed $10,000 on a credit card, in Canada, most of our credit cards are around 19.9%. If you made a 3% minimum payment, it will take you 22 and a half years to pay it off, and you will have paid $11,976 in interest. That's more than what you actually owed in the first place. So credit cards can be great. I'm not a fan necessarily of saying never use a credit card. I think they can be great as long as you're paying it off in full, preferably every month, but at least in a 2 to 3 month period if you need to. But yeah, paying that minimum on a credit card, that is going to drag you down. And there's no investment that's going to guarantee you 19% interest or return. So you should be doing that as a top priority anyways. So
yeah, I mean, no, if you ever get the question like, what should I do first? 100% pay off your credit card. There's never going to be a return that's going to guarantee that you're going to save 20% immediately. Yeah, I mean, credit cards are good for points and creating credit, but they are also the devil, in my opinion. They charge on every end.
yeah.
They can increase your limit with no financial underwriting.
Yeah.
So I remember one time a banker called me and was like, "Do you want to increase your credit card limit 5,000?" And I was like, "No, but I'll increase my line of credit 5,000." And he was like, "No, we can't do that. That's too risky for you." And I was like, "Yeah, that makes pretty good sense. That so you can hand out 5,000 of credit at 20%, but it's too risky for me to hand out 5,000 of credit at 6." And that's just the way that somehow they have control over the fact that it doesn't matter. And that's why I've literally seen people with credit card debt that is as high as their income.
Yeah, me too.
And you could never get a loan that high.
Yeah.
And so what the hell? Like, and I hate credit card companies more than all of the others combined by far because of the damage that they've done. So don't overuse it. Watch what you're spending on it. Try and get it paid off. Find any way to pay that off because it will eat you alive.
Yeah. Yeah, I agree.
Sorry, I went on a rant there.
No, it's all good. It's a slippery slope for sure. Okay. Number five, I think. I haven't been counting. Good stuff.
I can't count, so
Fair. Yeah.
It makes me a great financial planner.
That's not necessary at all. This is more for business owners, I guess. So write-offs. So we hear people talk about write-offs all the time.
Mm-hmm.
Oh, it's okay, it's a write-off. And so they end up spending far too much. And it's just this like imagination, I guess, that write-offs do not actually cost you anything.
Right. It's the best. So yeah, it's a good one for me to talk about because I always like it's hilarious. Like, and I know, right? This is money that costs. If I'm writing anything off, I spent the money, right? Like, so if I go for lunch right now, I'm going for lunch after we do this with someone, and I'm going to pay, and I can write it off. But that doesn't mean that I didn't pay for lunch. That just means that the K4s, income gets to be reduced by whatever this costs, but it's still coming out of my pocket to pay for lunch. And it always works. If you ever want to be like to anybody, if they're like, no, let me pay. And I'm like, look, I'm gonna pay for this one. So I'll just be like, it's a write-off. And then, oh, okay. Because most people are like, oh, that's free all of a sudden. But it's just like the easiest way for me to explain that. No, it still costs the business owner money. Every business owner knows that it's money out of their pocket. But sure, it's a little better than paying it personally, of course.
Yeah, for sure.
And it is. And I mean, of course we like write-offs, but it still comes out of, the revenue. So it's less money that we're taking home in our pocket. So,
yeah, it's
but
still has to
lunch,
be paid for.
right.
Yeah.
So, and they only let us write off half of lunch.
I was just going to say, yeah, in the case of lunch, it's only half.
Right.
So everyone's got to eat. All right, last
one.
Yeah,
we're not allowed to eat for free. That's why. Right. That's why.
No free lunch.
And golf, you can't write off golf, which drives me bananas.
Yeah.
I guess people would probably take advantage, but
you think so? Good.
No, never.
All right, last one from me then. It's about RSPs, and just the misconception is actually that RSPs are for everyone, and they're not. The TFSA, going back to that topic, only came into existence in 2009, if I remember correctly.
Mm-hmm.
And so before then, yeah, the RSP was much more maybe relevant to people's situation. And the RSPs are still great. Like I'm not saying that they're not,
mm-hmm.
but if your early career, in particular, if your early career with big income growth potential, it makes no sense to be looking at an RSP. You may as well invest in the TFSA. You can always move that money into an RSP at a later date.
Mm-hmm.
The thing with RSPs is, yes, it generates a reduction in your taxes or a potential tax return, but you have to pay taxes on the way out. So the key is to make sure that you are getting a refund at a higher tax rate than what your expected retirement income tax rate will be.
Mm-hmm.
Hence the need for a financial planner, because that's part of the things that Kent and I talk about. You're going to be anticipating a tax rate of X in retirement. So if you're below X now, RSPs don't make sense. Let's wait until you're higher, or let's just keep investing in the TFSA. Because again, if you think about the TFSA as the ultimate investing machine, or the TFIA, it is a retirement planning tool. And so you can use that going forward. So RSPs are wonderful, but they're not necessarily for everyone.
No, definitely not. And the one thing I hate to see the most is students putting, or unemployed people. Oh, I got to get money on my RSP this year. Like I got to put money into my wife's RSP or husband's RSP, and they didn't make any money. Absolutely not. But the students do it because their parents are like, well, put money in, put money in your RSP. But it actually will not be advantageous at all if you do it that way. So just make sure it's the right time and it will work for you. I know RSPs they're like one of probably the second most misunderstood thing beyond after taxes in this, if you're asking me, which is because they're combined. And RSPs are a great retirement tool, but they don't need to be overused necessarily. They don't need to be used in every case, and always use the TFSA. And you can use the TFSA to allow flexibility to do that with your RSP later, which is great, right? You have a huge year in your 50s or 40s or whatever. You can just make one big time, lump sum
transfer
move into your RSP and get a huge refund that year. So, I think that was 6 good ones. I mean, there are plenty more for sure. Hopefully you guys learned something. Thanks for tuning in. If you stayed in all the way, feel free to like and share or subscribe or whatever it is you do. Chad and I are going to, how often did you tell me that we were going to do one? Once every week or 2 weeks? Chad's the boss now, so we.
The goal is, we're going to see, Kent and Chad together at least once a month going forward.
Okay, perfect. Yeah. And if you guys have some ideas or things you want to hear us talk about, that would be fantastic to say, can you guys talk about this? Happy to have a conversation about anything. And Sean and I are trying to get some new video gear set up. So hopefully we can, produce more videos and add more little things in where it's easier for me to explain and teach what's going on.
Right on.
Thanks again. Thanks, Chad.
See you, Ken.
We'll see you soon.